Silver didn't just survive the bloodbath, it exposed what was actually weak, and it wasn't the fundamental story. It was the leverage. It was the paper positioning that can vanish in an afternoon when liquidity thins and risk managers flip the switch. And here acts the part most people missed while they were watching the red candles. The market didn't fall apart because demand disappeared. It fell apart because the plumbing demanded cash. That difference is everything, because if this was a structural break, the bounce would be dead, quiet, unconvincing. Instead, you got something else. A fast, aggressive attempt to reprice back toward the zone that matters. And that zone is 75. Not because it's mystical, because it's where behavior changes, where forced sellers stop being the price setters and where the next wave of buyers starts treating dips like inventory. And in a second, I am going to lay out the one hidden mechanism that turns yesterday's crash into the start of a recovery, not the end of a run, plus the exact checklist for the next week or two that tells you whether $75 becomes the new floor or whether this rebound gets rejected and turns into another trap. But first, we need to tell the truth about what actually happened, because the headline version is designed to make you emotional, not accurate. Silver ran into year-end with a level of momentum that makes markets dangerous. It had just printed an all-time high around the low to mid-80s with $83, 62 getting tagged in recent trading. After a year that, by any historical standard, was explosive. That kind of move attracts two groups at the same time. Real buyers who they've been waiting for years for a regime shift, and late leverage that shows up when the move is already obvious. And those two groups react completely differently when volatility spikes. The real buyer thinks in windows, in supply response, in macro direction. Late leverage thinks in margin, in P&L, in not getting stopped out. And that's where the pressure starts. Because when the market is calm, leverage looks like genius. When the market gets jagged, leverage becomes a forced seller. Here's the hidden detail that reframes the whole bloodbath narrative. The exchange raised margin requirements for precious metals, futures, into extreme volatility. That is not a rumor. That is a mechanical event. And when margins jump, when the amount of cash required to hold the same exposure suddenly rises, some traders don't ought to choose to sell. They are required to. They either wire more collateral immediately, or they reduce position size. And in a fast market, reduced position size becomes market orders into thinning liquidity. That's how you get air pockets. That is how you get the kind of waterfall candles that make people swear the story is over. And that mess also why those moves can reverse faster than anyone expects once the forced selling finishes. Because the selling wasn't an argument, it was a cash call. But that's not the part that matters most. The real pressure comes from what margin hikes do to the ecosystem around the trade. They don't just hit the guy with a big futures position. They ripple into options, into dealers, into hedge books, into anyone using silver exposure as part of a broader risk structure. When volatility spikes, risk limits tighten. When risk limits tighten, liquidity providers quote wider. And when spreads widen, stops get hit more easily. When stops get hit, the tape gets faster. And the faster it gets, the more people confuse flow with information. That is the psychological trap. And the market loves it. Now put that mechanical shock into the worst possible timing. Thin holiday liquidity, year-end book cleaning, and a market that had just gone vertical. You don't need a conspiracy for a crash. You need crowded positioning, plus a margin shock, plus a thin tape. That's the recipe. And yesterday, that recipe cooked. Silver dumped hard from the highs into the low to mid-70s, with prints around the $73 handle showing up after the flush. That's a brutal move. It feels like the floor disappeared. But now, listen carefully. Brutal does not mean broken. Brutal often means the opposite. Brutal means the market found the leverage and ripped it out by the roots. And once that happens, the next move can be cleaner. Because the sellers left are no longer must sell, they're want to sell. And want to sell is a much weaker force than must sell. That one distinction is why recoveries start exactly when the crowd feels most betrayed. And that's where the $75 line comes in. Because $75 is not the high. It's not the dream target, it's the behavioral pivot. It's the zone where the market decides whether the flush was a reset inside an uptrend or whether it was the first crack in a blow-off. If silver can reclaim and hold $75 with acceptance, meaning it trades there, it stays there, it treats dips into that zone as bid, then $75 becomes a floor, not by prediction, but by the actions it forces. Shorts, who press the crash, start getting uncomfortable because rallies off a forced liquidation low have a nasty tendency to squeeze. Dip buyers who missed the highs start treating every pullback like a gift. And dealers who are short calls or hedging options exposure can be forced to buy into rising price to stay neutral. And that's the next detail that flips the whole setup. Because silver is not just a spot market, it's a derivatives arena where hedging flows can accelerate moves in both directions. If price starts climbing back toward a key strike zone, levels where a lot of options sit, dealers hedge. They buy as it rises and sell as it falls, and in certain regimes, that hedging becomes reflexive. That's how you get melt-ups and trapdoors, not because everyone suddenly believes, because the hedging math demands it, and after a margin shock, that math matters even more because the market is already on edge. So when I say $75 is the new floor, I'm not saying it's guaranteed. I'm saying it's the line that, if recaptured, changes the forced flows and turns them into forced buying. And if that line fails, if silver rallies up, kisses $75 and then gets rejected hard back into the low 70s, then the market is telling you the rebound is still mostly mechanical, not sponsored. That's your tell. Now, here's where the mainstream analysis stays shallow. They'll say silver crashed because it was overbought. They'll say profit taking. They'll say speculators got rinsed. All true, but incomplete. The more important layer is supply chain and demand structure, because silver's supply response is not like oil, it's not like wheat, it's not like a market where you can just crank a spigot next month. A big chunk of silver production is byproduct, produced alongside lead, zinc, copper, and gold. That means silver cannot instantly respond to price the way a pure silver mine might. Lead times are long. Permitting is long. Refining capacity is not infinite. And industrial buyers don't care about your chart pattern. They care about continuity of supply. And the world has been quietly telling you that continuity is under stress. Global industrial demand for silver hit a record around 5 million ounces in 2024, according to widely cited industry reporting, and the market has been running structural deficits, meaning demand exceeds supply, on the order of roughly 100+ million ounces in recent years, with estimates around 148. 9 million ounces of deficit for 2024 in that same framework. Those aren't trader vibes, that's material balance. And that's why a paper flush doesn't automatically fix the story. It can change the timeline, it can shake out the weak hands, but it doesn't magically create new metal. And that's where the real pressure starts, because when the market is structurally tight, volatility becomes a tool. It becomes the way the market rations demand. High prices and violent swings are not random. They're the system trying to allocate scarce supply among competing uses. Now add one more underappreciated catalyst that's landing right on the calendar: trade flow risk. Late 2025 headlines included talk that China planned to restrict silver exports in 2026 via licensing or tighter controls. Whether the market prices that in smoothly or violently, the direction of risk is obvious. Manufacturers and industrial users hate uncertainty in sourcing. They don't wait for the perfect confirmation candle. They pre-procure, they diversify, they secure inventory. And in a market where a large portion of consumption is industrial, solar, electronics, electrification, and increasingly data infrastructure, those procurement decisions can create a bid that doesn't care about day-to-day sentiment. That's not a guarantee of a higher price tomorrow morning. It's a reason the dip can be bought aggressively even after a crash. Because the physical world moves slower than the paper world, and that lag creates friction. And friction creates spreads. And spreads tell the truth when headlines lie. So what do we watch to separate noise from signal? We watch the structure. We watch whether silver's rebound is just a dead cat bounce or a reacceleration. We watch whether the market starts treating dips as inventory rather than danger. We watch whether the key zone gets recaptured. And we watch the indicators that don't show up in a 5-minute chart. One is the macro backdrop, the US dollar. The dollar made a soft start to 2026 after posting its steepest annual drop in about 8 years, around a 9. 4% decline in 2025 by widely reported measures. That matters because silver is priced in dollars. A weaker dollar is not the only driver, but it changes the slope of the hill. It turns hard asset bid into a broader portfolio expression. And markets have been pricing in the possibility of multiple rate cuts in 2026, which, if the path plays out, reduces the opportunity cost of holding non-yielding assets and can weaken the currency on the margin. Again, not a promise, a regime. And in regime shifts, metals don't move politely, they move in bursts. Another signal is institutional framing. In late 2025, silver was talked about increasingly as a strategic industrial input, not just a shiny hedge. In fact, the U.S. designation of silver as a critical mineral has been cited as a driver of investor attention. Why does that matter? Because it changes how capital treats the metal. When something is framed as strategic, procurement and policy risk become part of the price. And that shifts the psychology from trade it to own it. That's slow at first, then it gets loud. And if you want the cleanest proof that silver is being repriced as more than a trade, you look at the year it just had. Triple-digit percentage gains are not the signature of a sleepy store of value. They're the signature of a market that's waking up to constraint. But here's the trap. Once a market goes vertical, it invites bubbles. And bubbles attract leverage. And leverage makes the chart look like a heart monitor. Which brings us back to yesterday S Bloodbath, and why it might be exactly what the market needed to keep going. Because a parabolic chart that never corrects becomes fragile. A parabolic chart that corrects violently and then holds key zones becomes dangerous in the other direction. It becomes a spring. Now, let's talk about inventories, because this is where people misread data and get whipsawed. You'll hear, but there's plenty of silver in vaults. You'll see a headline that London Vault holdings rose, and you'll assume that means abundance. That's not how it works. Inventory headlines are not the same as available float. London Vault data has shown silver held in London vaults around 27,187 tons as of end November 2025, up month over month. But that number includes metal held for many purposes. Custody metal, allocated metal, metal held in accounts that are not for sale at any reasonable price, metal earmarked for industrial supply chains, and most importantly, metal that S in the right place for settlement isn't T necessarily metal that S willing to move. The market doesn't care if there. It's metal behind glass if it can, to be mobilized without a premium, a delay, or a dislocation. That's why tightness often shows up not as zero inventory, but as friction. Longer lead times, higher premiums, widening spreads, and aggressive bidding into dips. So when you see vault totals rise at the same time price holds up, it can actually be a sign of institutional accumulation and custodial demand, not a sign the bull is dead. The next detail is what flips the whole setup. Paper can dump instantly, but physical adjustment takes time. Mines can't ramp overnight. Refiners can't teleport capacity. Logistics can't ignore bottlenecks. And when industrial demand is running at record levels, the physical market behaves like a slow-moving constraint system, not a day trader's playground. That means the price path can be ugly even in a bullish regime. It will trap you if you expect a straight line. It will reward you if you think in levels and scenarios, which is exactly what we're going to do now, because this is where audience trust is earned. Let's define the levels and the scenario lens without pretending we can predict the next candle. The first big reference point is the crash low zone, roughly the low to mid 70s, where the flush found bids after the margin shock. If that zone breaks cleanly and silver accepts below it, meaning it trades there for days, not minutes, then the market is telling you the unwind is not finished. The next level is $75, the pivot. Not because it's a magic number, but because it's where the tape changes character. Reclaiming $75 and holding it turns the narrative from post-crash damage control to trend repair. It forces shorts to manage risk differently. It forces dip buyers to step in sooner, and it changes how dealers hedge. Then above that, you have the psychologically loud zone near 80, and the recent record high region around 83. 62. That is the ceiling everyone will stare at. That's where you get the "it's overextended" chorus again. And that AS, where you can get the most violent move of all. Because if the market approaches those highs with a repaired structure and crowded skepticism, the squeeze potential rises, and that's where the real pressure starts. Now, the calendar trigger, the why now, is not one thing. It's a cluster. It's a, you just came through year end, funds rebalance, risk managers reduce exposure, traders crystallize gains, liquidity is thinner around holidays. At the same time, a margin shock forced immediate cash decisions. And right as the calendar flips, policy and trade flow narratives intensify, like export licensing or restrictions that start in 2026 and strategic mineral framing that shifts how portfolios think. That cluster creates a unique setup. Volatility spikes because positioning was crowded, but the underlying bid may be strengthening because the regime is shifting. That is exactly the kind of environment where 75 can become the line the market can T unsee if price action confirms it. But if it doesn't, the same volatility will be used to punish anyone who confuses a bounce with a base. So here is the two scenario lens you need to stay sane. Scenario 1 is controlled. Silver stabilizes above the crash low zone, grinds, retests, and then reclaims $75 with multiple closes above it. In that scenario, volatility may remain high, but the character changes. Dips get bought faster, sell-offs get shallower, the market starts to feel heavy on the downside and quick on the upside. That's what accumulation feels like. It's not pretty. It's not smooth, it's relentless. Scenario 2 is the continuation squeeze. Silver snaps back toward $75 quickly, pushes through, and momentum accelerates into the upper 70s with gaps and fast candles. In that scenario, the risk is not missing the move. The risk is getting whipped out by intraday violence while the bigger trend continues. Because squeeze regimes are where the market moves the most money and creates the most emotional casualties. In both scenarios, the key is the same. Identify what would confirm the thesis and what would invalidate it before the tape tries to hypnotize you. Confirmation looks like acceptance above $75, not just a tag. It looks like pullbacks that hold higher lows. It looks like sell-offs that don't cascade the way they did during the margin flush. It looks like the market refusing to spend time below the pivot. Weakening looks like repeated rejection at $75, with heavy selling every time it approaches, combined with a return to the crash lows that feels too easy. Invalidation is simpler than most people make it. A clean break below the post-flush support zone with acceptance, followed by failed bounces. That doesn't mean silver is dead forever. It means the market needs more time to digest, and that's where risk management becomes the difference between being right and getting wrecked. Because silver can whip around violently even if the thesis is correct. That is not a side note, that is the main feature. Silver is a hybrid asset, monetary narrative plus industrial demand plus derivative structure. So it often behaves like a risk asset and a hard asset in alternating bursts. One week it trades like a safe haven. The next week it trades like a leveraged tech stock. And the market will use that identity crisis to manipulate your emotions. Here's the viewer psychology shield, and I want you to actually internalize it, because it's how you stop becoming exit liquidity. Volatility is not the market telling you you're wrong. Volatility is the market fishing for your behavior. The tape speeds up, your brain panics, you make a decision you didn't pre-plan, and then the market reverses right after you act. That isn't bad luck. That's how most people are engineered to behave under uncertainty. So you have to separate trend signal from noise. Trend signal is structural. Reclaiming key zones, building higher lows, staying supported after shocks, macro tailwinds like dollar weakness and rate expectations, supply constraints like record industrial demand and recurring deficits. Noise is the intraday drama, a single headline, a single candle, a single flush caused by margin or liquidity. Noise is designed to feel like destiny. It's not. Your job is to define your levels and your time frame and then let the market prove it. And here, it's a simple rule that keeps you from getting played. Done to make big decisions inside the same emotional window that the market just shocked you in. After Bloodbath, the tape will swing your mood every 10 minutes. If you let that decide your positioning, you will sell low. And buy high, even if you think you're being disciplined. Discipline is pre-commitment, not reactive intelligence. Now let S stack the proof points, because you never want to believe a single argument in a market this violent. Proof point 1, the move itself. Silver tagged an all-time high around $83, 62s, and then dumped into the low 70s. That's the signature of a crowded, leveraged market getting cleaned. It's painful, but it's also how trends survive. Proof point 2, the catalyst wasn't demand vanished, it was mechanical risk. Margin requirements were raised and the market had to deliver. Forced flow, not fundamental collapse. Proof point 3, the macro frame remains supportive. Precious metals entered 2026 strong after a huge 2025, and the dollar began the year soft after a steep 2025 decline, with markets expecting additional Fed cuts. A softer currency and lower real rate expectations are classic tailwinds for metals, especially when trust in policy stability is shaky. Proof point 4, the supply-demand balance is structurally tight by widely cited industry accounting, with record industrial demand around 680, 5 million ounces and a meaningful deficit estimate around 148, 9 million ounces in 2024. That is not something a single crash fixes. Proof point 5, inventory headlines are nuanced. London Vault holdings around 27,187 tons show there is metal in custody, but that doesn't equal available float. And custody growth can align with institutional demand rather than surplus. Proof point 6, policy and strategic framing are changing the narrative. Silver, ES, critical mineral, designation, and export control talk raise the stakes for industrial procurement and reinforce the idea that silver is not just a speculative toy. Proof point 7, the calendar itself, year-end liquidity and rebalancing amplify moves, and when a margin shock hits inside that window, the tape is more likely to overshoot in both directions. That stack doesn't tell you the next candle. It tells you the environment. And the environment is exactly where recoveries begin after bloodbaths, because the market tends to overshoot in thin liquidity, then mean revert, then reprice once the forced flow clears. But don't get hypnotized by the bullish narrative either, because there are real counterpoints you have to respect if you want to survive. The first is simple. After a 147% year, silver is ripe for profit-taking and speculative excess. Even in a bull market, it can correct 20% to 30% and still be bullish. If you can't emotionally tolerate that, you will make the wrong decision at the wrong time. The second counterpoint is the dollar can snap back. A softer start to 2026 does not mean a straight line decline. If U.S. data surprises stronger, if policy expectations shift, if risk-off returns, the dollar can rally and metals can get hit, even if nothing changed structurally. The third is that exchanges can adjust margins again if volatility persists, and that can create repeated flushes as the market tries to find a stable leverage level. That's why you need levels and scenarios, not faith. So what comes next, specifically, over the next 1 to 2 weeks? Watch the $75 pivot like a hawk, but watch how it's traded, not whether it's touched. If silver pushes up through 75 VA and then immediately collapses, that's not a floor, that's a ceiling. If silver pushes through and then spends time above it, retests it, and buyers defend it, that's the market building a floor in real time. Also watch the behavior around the post-flush lows. If every dip toward the low 70s gets bought faster and with less panic, that suggests the forced sellers are gone and real money is stepping in. If dips start accelerating again, if liquidity feels like it disappears and the market starts accepting lower levels, then the unwind is still active. And here's the micro detail that matters. After a crash, the first rebound is often short covering. That's fast and sharp. The second phase is what tells you if it's real, because the second phase requires new buyers, not just trapped sellers exiting. The second phase is where institutions quietly build positions and where physical buyers lock in procurement. If that phase shows up, the trend can reassert. If it doesn't, you get a choppy range that bleeds confidence and punishes impatience. And that's where the real pressure starts. Because most people can handle a crash. What they can't handle is boredom after fear. They get chopped to death, they lose discipline, they overtrade, they become liquidity. Don't do that. If your thesis is that silver is repricing against the dollar, and that $75 becomes the new floor, then your job is to watch whether the market can reclaim and accept that zone while the macro and supply narratives remain intact. You don't need to predict the day it happens. You need to avoid getting emotionally manipulated while it's building, because volatility will be used against you. It will be used to make you feel stupid for being bullish on down days and stupid for not chasing on up days. And the market doesn't care which mistake you pick, as long as you pick one. So anchor yourself to process, define the level, define what confirms, define what invalidates, define your time horizon, and accept that price can whip around violently, even if the thesis is correct. That's how you keep your edge. Now I'll give you the simplest near-term checklist that cuts through the noise. 1. Does silver reclaim $75 and hold it for more than a moment? 2. Do pullbacks stay above the post-flush support zone, or do they break and accept below it? 3. Does the tape feel like selling is running out of ammo, or does it feel like every rally is being used to exit? 4. Does the dollar stay soft, or does it begin a sustained rebound that pressures metals across the board? 5. Do you see signs of tightening in the real world? Procurement urgency, strategic framing, supply concerns, continuing even as price whipsaws? You don't need all 5 to be bullish, but you need to know which ones you're relying on, because if the ones you rely on change, you adjust. That's not fear, that's competence. And if you want a concrete way to think about targets without pretending this is guaranteed, think in zones. If $75 is reclaimed and defended, the next magnet is the upper 70s, and beyond that, the psychological $80 zone, and beyond that, the record high region that everyone remembers. But those targets are not trophies. They're pressure points, levels where behavior changes and where volatility can explode. And the invalidation is equally real. If the market fails to hold the post-flush lows and begins accepting lower prices, the timeline extends and you stop treating rebounds as the floor is in. You treat them as rallies inside digestion. That is how you stay solvent. And that's the entire point. Not hype, not doom, process. Now here is the quiet truth that will make you money over time if you let it. The biggest moves in markets don't happen when the story is clean. They happen when the story is obvious, but the path is violent. They happen when the mainstream is late, when leverage is crowded, when the structure is stressed, and when the physical world can't respond quickly. That is silver right now. Strategic asset meets industrial constraint meets derivatives reflex. That's why it can crash in a day and still be building a floor. And if you're still here, you were not chasing candles. You were building a framework that doesn't get shattered by a single session. So do one thing that separates pros from tourists. Pick your level, say it out loud, put it in writing. What level would confirm your thesis? What level would invalidate it? If your answer is, I don't know, then the market already has you. If your answer is clear, you can survive the noise and let the tape prove itself. And if you want to be part of a community that thinks like that, skeptical, mechanism-driven, not easily shaken, drop your key level and your invalidation in the comments so we can compare notes like adults, not like gamblers. Because if silver turns $75 into the new floor, it won't announce it with a headline. It will announce it by refusing to go back below it, and that's when the math changes.